Today is a special episode because we have a special guest, Arthur Cheong. He's a DeFi investor, and if you're on Twitter, you should know him by Arthur0x. He talks a lot about DeFi. He has been investing in the space for a while. Today we're going to sit together with him to understand what makes a good token economics so that investors are interested in investing in that. In this interview with Arthur, we covered quite a bit of things. So what makes a good token? What are some top 3 tokens that he thinks has good token economics? The evolution of token as a form of equity, the retalisation trend in DeFi, the factors of due diligence when he as an investor is looking at different tokens and tokens to invest in. We also talked about some trends in DeFi, which is yield farming, where is the economic value coming from, and also what DeFi will look like in the next couple of years. And lastly, before we end, he gave some advice to token engineers and economic designers of what to look out for when you're designing your ecosystem. So let's get started. What makes a good token then?
The number one factor is there must be a concrete value accrual, or what we call value capture. So what does it mean that tokens have something that will be very different? The most popular crypto is Bitcoin. So Bitcoin is investable because getting a great institutional goal is a store of value because people believe that it has a scarcity in supply and has held its value pretty well over the last 10 years and also have shown the most reliable returns. So Bitcoin is investable because it's a good store of value over the medium to long. Store of value, Bitcoin is a very huge network. So if you're like Litecoin or other smaller crypto, you will struggle to beat Bitcoin as a good store of value because this money has a very huge network effect. It's just like US dollar. They have a huge network effect, and when you are using US dollar, you are less likely to use other smaller currency as your day-to-day transaction globally, be it like the international commerce and also like the financial activity. Most of it are denominated in US dollar. Same for crypto. Beyond money, what other investment is some crypto that give you some sort of value capture, like you have some claim to the cash flow, either through a direct reward distribution or have some sort of buyback and burn mechanism. So these are the ones that make it a good token. And ideally, the token should also be able to help to grow the platform or the protocol further. Because that's actually one of the main advantages of having a token, that it can help you to bootstrap the growth of the protocol compared to like normal marketplace economy that struggle for bootstrapping.
That's the trend that we're seeing as tokens are being used to bootstrap crowdfunding in the ICO phase in early 2017-2018.
They are mostly using token as a means of payment. And actually this is a very big challenge because you are actually adding the friction to the adoption of your product or your network. Because if I can pay for certain product services with other more stable unit of account or even just US dollar, it's much more convenient. And if you are forcing users to convert to your token to pay for services, it's a friction and it's a volatile unit of account.
Today, we're seeing a different trend. We're looking at yield farming, where projects are way beyond just a white paper phase. They have a product that's ready to be used and looking at a product market fit. So tokens now are used in a different form to bootstrap the network with a usable service that's available. Given that token structure and token design have evolved with all these years, what are some 3 tokens with very good token economics that you have seen?
Top 3 tokens with token economics. I think the first one I want to say is synthetic network token. So why it has good token economics? Because it's very straightforward. In essence, synthetic exchange is synthetic asset protocol, or you can think of it as a derivative. And the fee comes from the fee that the network charge on people using the network itself, which is right now, which is trading across different synthetic assets. So you can trade it from a synthetic US dollar to synthetic gold or synthetic silver, and there's also going to be more synthetic asset in the future. So the analogy is like you're owning a piece of CME. So Chicago Mercantile Exchange. Whatever fee that this exchange charge will go to the token holder. So this is how good analogy. This has good token economics because it's very clear that where the value capture comes from. There are more adoption, more usage of this protocol, the more fee that will go to the token holder. So this makes it investable. And another factor is we use inflationary reward to bootstrap the network because at the beginning the fee is not sufficient to really incentivize people to use it or to stake it to provide the liquidity to the platform. So by having a significant reward to bootstrap the network, they help to propel the network to a higher level where they attract more and more users to come in. The liquidity has also increased massively throughout the process. So after we introduced the new token economy where there is inflation to fund the growth of the network, the market cap of the token has increased from less than 10 million to almost 300 million. So there is a huge evidence of success. Another token is a Kyber network. So Kyber network is the same thing, a token of a decentralized crypto exchange, and it's also a very similar model. The fee comes from the usage of using the Kyber network to trade. And this one, they are also distributing the fee reward directly for the token holder participate in the governance of the network. So right now they just launched it this week, and for any token holder that will vote for the governance proposal Kyber DAO, they will be able to receive the rewards payable in ETH, the native currency of Ethereum. So I think that's another good example where there's a very clear value. The last token I would say has a good token economic is Luna. So Luna is the collateral crypto of Terra. So Terra is a stablecoin protocol. It's already achieved a very huge mainstream adoption. There are more than 1.5 million total registered users and a daily active user of 50 per thousand. So the advantage of using this payment method is it's cheaper compared to the credit card for merchants. You're also able to offer a higher discount. For most merchants, they pay 2 to 3% for using Visa or Mastercard. For Terra, they only charge less than 1% for the transaction for using their stablecoin. And this fee go to all the Luna token staker that is providing the collateral to generate this stablecoin. There's a very clear value capture. Right now, the staking return for Terra is 13-15%, and this is all non-dilutive, and they are not using inflation to pay, but instead they're using transaction fee to pay. So another analogy of this is they are like owning a piece of Visa, except that you're not owning an equity, but you're owning a token, where all the transaction fee that Visa charges you as a token.
So if I can summarize, the 3 points that make these tokens very well designed with good token economics is that 1, it's able to tokenize the economic value accrued by the network so that it can be distributed to the users and to the community, because at the end of the day, one of the principles is that decentralization also means equality or distribution of power and equality to the community and to users of the community. The second is that there has to be very clear value accrual or value capture either within the ecosystem or compared to alternatives or options outside the ecosystem, so off-chain solutions. The third thing is that tokens are not just a one-off asset or one-off thing to have one objective, which is probably a store of value. But tokens have a lot of other use cases that needs to be tapped on, like a way to bootstrap the ecosystem. So it's more than just one objective that the token serves, but has a lot more secondary and tertiary objectives that the token has to serve. So really, to maximize the usage of the token or to maximize the existence of tokens in the ecosystem.
And ideally, I think one of the advantage compared to equity is that you can use it to incentivize more growth, because in a normal traditional startup, it's actually quite hard and almost impossible to pay to give out your equity to a user. But for token, it's very easy. You can use it to pay to your users so they can have an upside in the success of the product or the project as well. I think this is a very huge game changer.
I've been thinking a lot about equity, and that equity is very different from tokens as a form of equity, as a form of financial security, because equity really has an off-chain governance. You have the SEC or you have the various financial arms or financial departments in a country to govern the security or to govern the legislation around equity. The thing about tokens is that you don't have that. You have to take on the risk as an investor or as a believer of the token. You can't outsource the risk to laws and to legislations out there. With tokens taking on a more financial security or equity role, then the user, the investor, is taking on more of the risk that would have been outsourced to the financial authorities and regulations and law.
Yes, I think this is definitely a very new area, and you do not have as strong guarantee as what you get in the traditional world, which is also why there's higher risk and higher reward, and you pay more reward to the investor that are willing to spend more time diligence, do a deeper research, and really talk and communicate with people.
Talking about due diligence, the other effect of decentralization is retailization. So a lot of retail investors, retail traders coming in instead of institutional ones. And this is both good and bad, because the good thing is that it serves the whole idea of decentralization. You give power back to the people get to make decisions. You don't have institutions coming in to gather all the power in a capitalistic world. So it helps to distribute that power to individuals. But now the bad thing is that it increases risk to people. It is about intensifying instant gratification because people are looking at 10x growth. It's about less responsibility for the actions because now individuals are responsible for how they trade and they can't just blame someone else, blame the institutions for that. They have to be the one responsible for it. And people are not really ready for this level of responsibility. And lastly, it's very easy to scam. Why? Because the thing about due diligence is that it's not easy to do. Here we are talking about what makes a good token, what makes good token design, what makes good governance, what are tokens becoming a form of security, a form of equity. And as a retail guy, as a person trading for fun, you might not have the full knowledge and full information to do the right due diligence. So what I've seen a lot of people doing is that they're just following these DeFi investors or DeFi influencers to follow what they recommend online, which is good. The risk is that there could be 10 influencers being paid to show some shitcoin, and these people who don't know how to do due diligence, who don't have time to do due diligence, who don't know how to do due diligence, are just following the advice. So it becomes like a long-term explicit scam going on.
Yes, I think this is definitely a trade-off. Ultimately, I think a fool and his money will soon part. I think this is for anyone who really want to generate a sustainable return, they just have to do the due diligence. I am a big believer in empowerment, self-empowerment. So a person that is very reckless, you can always lose their money. I would say more people have lost money in other non-financial places because usually it's more well regulated. And I think the whole retailization, see a trend of gamification. You need something more fun and exciting to track. Plus, the due diligence and putting more effort to their own research is just something that every serious investor can do for themselves. And there will be a lot of other ways that investors can lose their money, not just because they see that 10 people. So I think this is all about individual and how do you really protect yourself in because of whatever things you invest in, be it crypto, maybe the stocks of the bank of companies, or even whatever other things that.
As a DeFi investor then, what would be your top 3 factors and features that you look at when you're doing due diligence for crypto?
The most important thing are, especially when you're talking to less established insurer people, is definitely the team. You need to ensure that the team have a pretty strong integrity and the right vision that they want. For most protocol, at this stage, they still exert a zero power to the protocol. It's not just for the project, but also work hard on the project. So I think this is very important. You want to invest in protocol on the project with the team and have the right values and vision. And I think another thing is also you look at the product they're building. Do they have a real product? Does this solve a real use case? So right now, I would say that there's a mix of both. There are some that's really strong, and there are some that is actually more conceived and there's no fundamental value. I would say the third thing is also the valuation. I think this is very important. I mean, a bad asset at a good price is investable, and a good asset at a very bad price is probably not investable. So I think when you look at something that is very promising, but it's already trading at a very, very high valuation, probably need to think twice for investment. Let's say a good project can usually grow beyond its current valuation. So you do need to see that whether this project has reached its growth potential. If there's still a lot of growth potential, it can be still worth it to invest in, although it's trading at a high value. You also have to be realistic because let's say Bitcoin is worth 160, 70 billion right now. If a project is already trading at half of Bitcoin valuation with like way earlier stage of progress, it's probably good to ask for something.
I think one thing that's very important is that you also mentioned is that tokens have to be fundamentally well designed. What will be the two fundamentals that you look at to show or to prove that these tokens are fundamentally well designed and not having just hypes or pump and dump to increase the price and the value of the token?
I think this is pretty standard. First of all, you look at, for DeFi protocol, most of them have some quantifiable metrics. Look at, be it the volume of the platform or a decentralization. For a lending and borrowing protocol, you will have the total amount of the deposits and borrow loans to the platform. So this is after you can quantify, you can see that whether is it growing on a consistent basis and how fast the growth is. And for the volume, likewise. And another thing you can look at is the user that is interacting with the protocol. Usually, if you have a good user growth, that is just the platform growth. So this is a few fundamentals you can look at for DeFi protocol especially.
A trend in the DeFi space is yield farming, and we talked about yield farming a lot of time. It's trending like crazy on Twitter for almost a month now. Just now we talked about how tokens are a way to extract the economic value of a platform, of an ecosystem, and then to distribute this platform or to distribute this utility or this economic value to the community, which is very good. What I'm failing to see is that in yield farming, where is this economic value coming from? All these DeFi protocols and platforms are still very new. And whatever incentive mechanisms like yield farming is not really sustainable in the long run, since a lot of trade are using leverage. So we are looking at a margin trade and not a real value that is being traded. It's a lot on margin, on leverage. So how would you justify the increasing monetary value of all these tokens that is accrued from yield farming?
Very similar to how Google, when they get started, they are paying for user to take their services and they are losing money on every single transaction that the platform is successful. But it helps to bootstrap the network. So I think for yield farming, it's very similar. A lot of the platform, they are paying a very abnormally high reward user for using their platform to bootstrap the network. Because for a lot of the marketplaces, it's always a legitimate issue that if you do not have enough supplier, the user will not come to your platform. But if you don't have enough user, the supplier also not incentivized. So by having a very high reward, you have to attract both the supplier and also the consumer to come and save. And hopefully, in the long run, it can grow into a sustainable economics. So I do think that the abnormally high reward will not last for very long. It's just the bootstrap of the network effect. Sufficient equity, the network effect, and then the reward will just start to come down. The reward will trend lower, but I think it is sustainable because of how you calibrate it.
I absolutely agree. And the other problem that I see is that I think DeFi should, or any technology for that matter, should be increasing the pie, increasing the size of pie, and not taking the pie and cutting it into smaller pieces. What I'm seeing is that a lot of investors are coming in, taking a big slice of the pie, and then selling their things off to be cutting that same amount of pie to more people and to be shared. It's not increasing the size of pie. So is this a zero-sum game? Or how can we turn this into a positive sum game down the road?
I think in terms of the expanding the pie, actually I think it was personally some of the most if you farmer is the people use. I actually talked to a lot of the new users that have actually never interacted with this DeFi protocol before, and they are actually trying it out for the first time because of this. So it did bring a lot of the users, even within the crypto space, there are actually a decent amount of users that never interacted. And these people are actually attracted to use it for the first time because of the so I think it did end up expanding the pie. But whether this money will stay in the long run, I think it will depends ultimately whether this product is worth justifying so that even after this reward. So I think right now the pie actually has expanded. Yes, the reward are still pretty top heavy. A few people getting most of the reward, but even for people who don't have a huge amount of balances, as long as they can justify the gas cost, it's actually still worth out for them to participate. The yield should be effective and can serve as an incentive to nudge people to focus on this matter. I think the world just moved for an incentive. So having incentive is always going to push people and nudge people to use their choice.
That's true. I absolutely believe that soon the market will come in, it will level up with arbitragers, with high frequency traders, and it will find a market price that is deemed reasonable or deemed efficient by the market. So going back to the topic of DeFi, DeFi is booming. 2019 was the year of stablecoins. In fact, Tether USDT has just reached $10 billion in the system. And that's a lot. It shows that people are demanding stablecoins, people are trading with stablecoins. It shows that that might be one of the ways for us to reach mass adoption in the DeFi or in crypto in general. So, what do you think DeFi will look like in the next 3 to 5 years?
I think the future of DeFi is likely going to start from adoption of developed market first, because you do require a certain level of technical sophistication to use it. Although it is improving very quickly, I think if you come from offering a broader access to various levels of financial product to user in the developed market, because even right now, most normal users, they only have access to the very familiar financial stocks and bonds, and the barrier to entry is pretty high for a lot of the other. So if I can bring a mass democratization to financial products to various users and help them in their wealth management and help them in their day-to-day finances, so I think the adoption will start. And I think we will see a deeper link because actually there's a lot of new bridge gateway coming out to help normal user interact with the DeFi protocol in a much more convenient and user friendly. And I think this is something that we need to accelerate and bring more normal users. Because even doing a relatively low risk high usage strategy, you get at least 3 to 5% of your deposits, which is way higher than what other developers is low interest rate. So I think this will slowly move more and more people into this space, but probably they are not fully DeFi environment. They probably still have partial custody. But I think this is what we see next. And I think stablecoin will continue to grow. And I think you will likely adopted as one of the main methods of settlement in a lot of places. Yeah, and in fact, for some cases, we can already see that it's much cheaper to settle a stablecoin than using a traditional financial chain. So I think stablecoin is definitely the biggest product market fit, followed by decentralized lending and obviously decentralized speculation. So there's a big use case. So I think this is the top 3 use case that's going to go mainstream.
I absolutely agree with your point. I just have a different view. I think the developed market is a great place to get started, but the less developed really has one of the best competitive advantage. If you look at the financial state of a less developed or developing country, they have corrupt monetary policy, although they don't really have that efficient leaders or that efficient governors to govern central banks and to have the right kind of monetary policies in place. The financial system is also quite unstable. It's especially for smaller countries, is prone to geopolitics, is prone to a lot of things that bigger countries are doing. So it's not very stable. So in that sense, crypto becomes a no-brainer. It becomes a very attractive alternative for them to get access to all the stable coins around the world, to get access to different kind of assets to give much higher returns than their unstable systems that they have in place. So I think less developed countries or less developed nations are probably the way that we can reach mass adoption.
Actually, I think that for the middle class, DeFi is definitely very attractive. It's not value. But the thing is language barrier. So you do need a very strong local partner to understand. And what I've seen is to a certain extent it replaces for Indonesia, for example, a lot of the payment domestically, they operate on an agent basis. So all these things, if you're going for pure online approach, it will not work. So I think that yes, for the developing country, there is a very strong use case, but execution part will be hard. You do really need a strong local partner as well, and invest a lot of effort.
Yeah, that's true. I didn't think about that. Before we conclude, if you can have one advice that you can give to token designers or economic designers, what would you give?
You need to know the comparative advantage of having a token compared to the traditional economic ownership method entities. So, and you use this to the most advantage because this allows you a lot of flexibility distributing the value generated by the project or the protocol you're working on. So do utilize this to the maximum. I think ultimately it is not make or break a platform. It is just a very good entry point. Because ultimately, you still need to have a very good product that makes sense for you to use in the first place. Just that having a good token can help accelerate your growth and convert your user to be a more devoted community member and possibly major investor in your project.
To summarize, that would be one, to know your key competitive advantage of using a token as opposed to the traditional market where no tokens are being used, because that's where the strength of tokenization lies. The second is to use token to its utmost advantage, to exploit and leverage all the benefits that token can bring. It could be incentivizing, it could be gamification, it could be reputation building. Use everything that tokens can provide to your ecosystem to help build it. And lastly is to absolutely find product market fit, because tokens are not a magic pill. It's not Jack and a Beanstalk where you have the pill or the beans and it will come out a beautiful solution to eradicate you from poverty. But tokens are really just a means to an end. Tokens are not an end to itself. And tokens can only help to accelerate growth if there's something worth growing. That means this product has good product market fit, that it's much better than alternatives in the space, that people are willing to use it, to test it, to try it. And these are the three things to summarize what advice that Arthur is giving to token ecosystem builders and economic designers. Well, thank you, Arthur. And for those of you who are interested in more topics like this, you can check out our Token Economics Blueprint course. The URL is here, and you can also scan the QR code to get access. We're currently having a discount, and the lessons are 10 lessons with 15 hours in total. You can just pick and choose the lesson that you want and pay accordingly. We're having a discount as well, so I'll see you there, or I'll see you in the next episode. Tell me what you're interested to look at or who you would like to listen to, and I can reach out to them as well. Till then, goodbye!